and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And so the show, we're talking about lessons learned from previous house price crashes. Now, we mentioned a couple of episodes ago a really great speech that the Reserve Bank Governor gave only a couple of weeks ago. And within that speech, he had a diagram of all the major advanced economy house price crashes since 1970. So that's when house prices have significantly fallen in other well-developed countries. Now, today what we're going to do is dig into these to see if we can tease out some of the common themes that have caused these house price crashes, and also talk about, well, what's happened since then to see if there's any lessons that we can learn. The idea being twofold. First of all, while I don't see a lot of people talking about house price crashes now, I expect that in 6 months' time, perhaps we're going to start to see people start to really worry about that. And the second reason I want to talk about it is, while history doesn't repeat, I always say it does certainly rhyme. So perhaps there are some learnings we can take from it. Before we actually dig into that, Andrew, something that I know isn't on your notes for this episode, but I was quickly doing the numbers last night. There were 18 examples of property bubble bursts within the Reserve Bank's analysis, and there were 17 which I was able to get data for. And I love a pop quiz. I do love a pop quiz. So what do you think of these major house price crashes? How long do you think it took to go from the peak of the market to its bottom point, to its trough? How long do you think it takes from a house... Yeah, across all of them, and I'm using the median of them.
I'm going to have 5 years.
Actually, you're pretty on track. 4.75, 4.75 years. So I was actually thought you were going to go way shorter than that, because New Zealand, at our last house price crash in 08 to 09, it took about 1.25 years to go from the peak to the bottom of the market. Whereas for some of those more established, the larger bubble pops, if I can call that, it took almost 5 years. Now, the next pop quiz for you is, how long do you think it took to go
so you're not satisfied with me getting a correct answer, are you? So go on, lob another one up the plate. I'm not.
How long do you think it takes to go from the peak to the fully recovered? So from house prices at their highest, the bubbles popped, but then it goes back up to the same level as it was before continuing on. How long do you think it takes for the market to fully recover?
7 years.
About 10 years, nine and a half years.
Oh, so you're happy now, aren't you?
I am. But one thing that I just want to say as well, when comparing these big bubble pops, the 17 the Reserve Bank gave, compared to New Zealand's most recent one between 08-09, is that the trough size, how far the markets have fallen internationally from these big bubble corrections, house prices at their median dropped 31% across this analysis of 17 bubble bursts, whereas in New Zealand, at our most recent correction, was 9.6% drop. So we haven't truly seen a bubble burst the scale that other countries have seen in terms of these big examples that the Reserve Bank is kind of looking out for, making sure that we don't hit. Now, what I want to do, Andrew, is let's go through 3 different bubble bursts and dig into them into some more detail to understand what's going on, what lessons learned. And I think one thing that I certainly have taken away from preparing for this is that it does make you appreciate the Reserve Bank a little bit more in terms of what they are trying to do, in terms of making sure that we don't have a bubble burst. So instead of allowing a whole heap of demand onto the market, prices rising even more than they currently are, trying to keep it back compared to what would otherwise be the case. Now, the first bubble burst I want to talk about is 1997 to 2003 in Hong Kong. Now, what you've just got to remember is we are about to simplify a whole economic downturn into 3 minutes, so we are going to skim over some things. But the reason that I wanted to talk about Hong Kong is that it's got a population of about 6.5 million people, not that much higher than, or at least, sorry, it had 6.5 million people at the time that this bubble burst, so not that dissimilar from New Zealand. Now, what caused the crash? Well, in the year preceding the crash, house prices in Hong Kong in a single year increased 45%. So an enormous amount. Now, you're probably thinking, oh, God, Ed, New Zealand's not that far off 45%. We've been about, 25, 26% in some cases. They were 45%, almost half in a single year. And what was happening at that time is there was significant investment going into a lot of Asian countries. And then 1997 comes along and the Asian currency crisis hits. So what that basically was a big downturn in a lot of really fast growing Asian countries, because there'd been a lot of investment from the West going into places like Thailand and Malaysia, Indonesia. And then all of a sudden, the tap gets turned off and people started pulling their money out. Some of those countries were revaluing their currencies and doing some things like that. But the key message is that money was flowing into these countries and then it starts flowing out. The banks didn't have money to lend, and so they weren't able to approve more and more mortgages. Of course, unemployment was going up at those times, or at that time, in most of these Asian countries because they were tanking. Hong Kong real GDP fell about 9% in the time afterwards. So the economy drastically shrank. And because of that, there wasn't much lending going on. People weren't able to afford to take out more mortgages. And I think the other thing is there'd been a lot of risky lending going on into property. So there were bad quality loans out there. People were forced to sell. Some of those were falling over. And because of that, we saw house prices drop of 65%. 65% over a 6-year period. So in 6 years, house prices dropped 2/3. They took 7.5 years for property prices to fully recover after that. So it was 13.5 years from the absolute peak to the biggest trough and then full recovery. But imagine if 2/3 of the value of your house just got wiped out. It would be so tough. And then, of course, you'd be really... Yeah, it'd just be such a tough time. Of course, what's happened since then in 2003, it probably doesn't surprise you that property prices in Hong Kong are now 2.27 times their 1997 peak and have just increased astronomically since there. But I think the key lessons that I want to dig into, first of all, is that if you are investing in an economy where there are big swings in foreign investment, so let's say that New Zealand had a whole heap of people dumping money into here because we were growing really, really quick. That has the potential to turn the other way and cause a depression. And then any time that there is a significant credit crunch, and what I mean by that is that banks don't have the ability to lend out mortgages, so that if you are forced to sell your property, it's hard for somebody to get a mortgage to then go buy it. That's going to be really, really tough. What's interesting is that even if prices do drop 2/3 in this instance, there is the opportunity for recovery. And we've seen that in this specific example as well. But really interesting example of like the absolute worst case scenario you can imagine. Let's transition over now to an economy that's a Western economy that's kind of more traditionally compared to New Zealand.
So this is Ireland, 2007 to 2009. So population at the time was 4.4 million people, so fairly similar sort of size to New Zealand. What caused the crash? So property prices went up 4.16 times in the space of 11 years. So just over 4 times in the space of 11 years. It's huge. It works out to be a compounding annual growth rate of almost 14%. Which is massive. We use 6% and 5% in our projections if it's a normal house. So that is massive. And because I guess there was such good growth, lenders were offering more than 100% loans so that people could buy a house and then fund furnishings or landscaping and all those kind of things. And of course, you're now giving loans to people which are well in excess of the value of a house, and to people who weren't necessarily able to sustain mortgages at this level. And there was poor financial supervision over the banks at the time. So how deep did the crash go? 55% decrease over 6 years from April 2007 to April 2013. 55% is huge. So over half your house value gone. And what's happened since is that prices are still 15% below the 2007 peak. And so, yes, they've still increased since then. So you've gone up by 86.6%, but there's a recovery, but not a full recovery yet. And I think the key takeaways and lessons from this are that borrowing over 100% is never a good idea, and borrowing 100% is not a good idea. And you've definitely got to be thinking about who you're lending to. So whilst we all complain about this responsible lending code, this is probably a good example of where banks are irresponsible, and then you have a major market crash as a result.
Well, let me ask you this then, Andrew. You just said that borrowing at 100% isn't a good idea, but we often talk on the show about investors purchasing properties with no cash in and with 100% debt. So you're saying that's a bad thing?
Oh, yeah. So just to clarify there, if you're borrowing 100% in New Zealand, you're borrowing 60 or 80% against your rental property, the other 20 or 40% is coming against your house. So you're never going to go above, generally speaking, 80% across the board. So whilst you might get 100% of the lending to buy a property, that's because you've got equity elsewhere. Whereas on this model, let's say you're just going out your first home buyer, you buy a house for 500k, but you take out a mortgage of 550 so you can pay for all your furniture. Oh, not a good idea.
Let's come across to another example, and this one's held up as one of the best managed property crashes in history. And in fact, I know during the 2008 financial crisis, a lot of people were looking to Sweden and what Sweden did between 1991 to 1993. Again, I've chosen this one because the population is relatively small at 8.6 million people, and so, somewhat comparable to New Zealand. Now, let's start with what had caused the crash. So before Sweden went through a really tough time and had a financial crisis, there were neighbouring financial crises in Norway and Finland. It's two main neighbours. There were also one in Japan, but that's a little further afield. And what had happened 6 years prior to Sweden's bubble burst was that there was significant liberalisation in credit policy. Now, what do I mean by that? It meant that, like in New Zealand around that period, a whole heap of the banking rules got cut back and banks were able to lend more and started competing aggressively for market share. And it was very easy to get a loan. So people borrowed and people invested in commercial property and shares and housing and all those kinds of things. And in fact, property prices doubled in the space of 6 years within Sweden. Now, what happened after that is a little bit... What happened after that was Sweden was plunged into quite a deep depression. Interest rates started to spike severely. And that was in result to, first of all, the Soviet Union, modern-day Russia, basically fell over. The Berlin Wall came down and Germany reunited. And when I talk about interest rates spiking, they went from about 1 to 2% in real terms, so the interest rate minus inflation, that it went from 1 to 2% up to 10%. So that's 10% plus inflation. So I think the 10-year government bond in Sweden was something like 14%, 13% at that time. So the mortgage rates were even higher than that. Now, because of that, people defaulted and it put the banks at risk, and the economy contracted by 25%. So just imagine, in this case, we've got the economy, being wiped out by a quarter of all economic activity just going. So unemployment spikes, people aren't able to service their mortgages. In terms of how deep the crash went, property prices fell 20% in 18 months. They actually took a total of 5.5 years. And then it took 5.5 years to recover from that trough. So property prices fell pretty quickly, took 5.5 years to recover, and it was 7 years in total from their peak before going down and then going back into a recovery. Now, what's happened since then? Well, property prices are up over 4 times that peak, that July 1991 peak. So, I mean, if you held on to your Swedish property for the last 30 years, you've done extremely well out of it. But I think the key lessons are that very, very sharply rising interest rates, so ones that increase by 5 or 10 to 10 times, are obviously very, very bad. So we're talking about, there are rising interest rates here in New Zealand, but we're talking about going from 2.2% to 3.6% in terms of the 1 year rate. In this case, we're talking about, if it was Sweden, we'd be talking about going from 2% to 12%. Now, if interest rates did go from 2% to 12%, no doubt would we have a very, very bad time as well, Andrew. We'd get a lot of investment pouring into New Zealand because our interest rates would be so high, but, it would be a similarly bad time. Now, the other thing here is also a debt binge that is followed by a credit tightening is obviously very bad. So if banks start to fall over and aren't able to lend out money, that is very, very bad as well. But one thing that I will just mention before we wrap up and kind of talk about, well, how much do these negative things that we've seen in these big bubble bursts compare to New Zealand? One thing that is interesting when looking at all 17 of the bubbles that we've got data for is that of them, 70% have recovered. So there are still, of the 17, 12 have fully recovered, 5 have still not fully recovered in terms of their property markets. And it's those places that have gone through a really tough economic time, places like Greece, places like Italy, places like Ireland, where they had big bubble bursts, and also, they in the places where people are relatively poorer. So naturally, people in Southern Europe are relatively poor compared to Northern Europe. And so their property markets haven't fully recovered yet. Well, let me ask you this, Andrew, because I know that we've got some avid listeners of Tony Alexander's Tony's View. And in his latest version, I saw that he was talking about that we're going through a bit of a mini credit crunch here in New Zealand with banks choosing not to lend. So how worried are you that we're going to go through a credit crunch and then potentially we might have a bubble burst in New Zealand, have a steep house price crash?
Well, I think the thing you've got to remember is that this is actually a bank's decision. It's a man-made credit crunch. So the banks have got plenty of money. They've got the ability to lend it out. It's just that they're not lending it out right now because they're trying to control the house prices. And the Reserve Bank have come up with all these restrictions like, the conversation around DTIs, which has now made banks implement them, the LVR restrictions. They can just as easily turn them off as they did coming out of COVID lockdown. So it could well be that, if we do see a drop in house prices, then all of a sudden the Reserve Bank wants to put some more fuel on the fire. They can just turn off those tools or maybe just tinker with them a little bit as well. Again, they can look at doing things like making the LVRs specific to areas as well, like they did with Auckland's percentages that they did with investments. So I don't think it's anything to worry about.
Yeah, the mini credit crunch is kind of what I'd call man-made in that it is a conscious decision rather than being forced to do it. Like there's plenty of money out there in order to lend. It's just whether banks are willing to lend it or not. And look, as much as we hate some of the RBNZ's restrictions, the Reserve Bank's restrictions, because we're not able to borrow as much and go buy more properties. We know reading through and doing this analysis has made me be a little bit more grateful for what the Reserve Bank is trying to do, which is trying to not have a 30% decline in house prices, and essentially keep them at the level they are. And again, I'm going to come back to that lock-in effect where the Reserve Bank's restrictions are kind of keeping prices where they are so that we don't see that decline. And so any house price rises we get are almost, I don't want to say locked in because of course they can fall, but they are, we can have some level of confidence in them. I think what else this shows, Andrew, is that the real risk is in first home buyers purchasing with 5% deposits, which are currently there, because that is the closest thing that we've got to 100% lending. Now, a lot of first home buyers, let's be honest, are not out there buying with 5% deposits, but the low deposit first home buyers are what we really could cause some sort of instability. But look, let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. And hey, if you want to learn more about property with Andrew and I, check out our YouTube channel, because every single Wednesday we release a brand new video to teach you something new about property investment right here in New Zealand. Thanks for listening to the Property Academy podcast. I'm your host, Edward Knight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.